Good morning, ladies and gentlemen. Y también buenos días al grupo de América del Sur. First, I would like to thank Mona 1000 and the Publish What You Pay organization for putting this important topic on the agenda. The issue of taxation of multinationals has been a priority for politicians and tax authorities around the world for a long time. But more recently, it had also made headlines around the globe. Aggressive tax planning has negative consequences. While mostly following the laws of each country, it is beyond doubt that their practice has some negative effects. Firstly, it creates unequal competition between nationals and multinational companies. Secondly, it erodes the tax base and thus our ability to deliver welfare services. And thirdly, it challenges people's opinion on tax morale and justice in general. And this last point, that's one of the reasons why it's so important to curb aggressive tax planning. It challenges the whole legitimacy of the tax system. Tax planning is often aggressive and in the grey areas of the law. It is an international push to amend the tax laws so that they are adapted to the 21st century. The focus has been on avoiding double taxation for large corporations, and now the focus is also on avoiding double non-taxation. The good news is that there is light at the end of the tunnel. There are some signs that the international development is positive, as we also heard Grace was expanding on. Firstly, there is broad global support for the OECD's BEPS work, which Grace presented just now, including from the EU and the G20. Secondly, there is considerably less acceptance for aggressive tax planning. Tax is gradually becoming part of corporate social responsibility. And thirdly, there is increased sharing of tax-related information internationally, including more open and transparent tax havens. Countries that previously did not provide us with any information have now signed information exchange agreements with us. We also begin to receive data when we send requests. And then one question comes to mind: why has this momentum shifted? There are mainly three reasons for that. The major countries have had to increase their revenue and can no longer accept the low tax the largest corporations benefit from under these tax agreements. Secondly, the United States has put, and also other international organizations, has put significant pressure on countries like Switzerland and their banks to stop helping citizens and companies to evade tax. And thirdly, the massive growth in the multinationals have had the past decade has highlighted the increasingly unfair advantage these tax structures give them over domestic companies. We have to distinguish between individuals and businesses. As we saw at the Berlin Global Forum this year, information exchange for tax purposes between countries relating to bank account information will be a reality in 2017. Just this week, Switzerland signed the Common Reporting Standard with the intention to start automatically exchanging bank account information from September 2018. The end of bank secrecy is therefore well and truly underway. Businesses, on the other hand, don't rely on banking secrecy rules. They rely instead of artificial arrangements that allow them to geographically separate their activity and their revenue on the one hand, and the profits on the other. This is the issue addressed through the BEPS plan, which received renewed support from G20 last weekend. In Norway, we have a well-functioning system of taxations of individuals and businesses that primarily operate domestically. But much remains to be done to force the multinational companies to pay taxes according to the intention of the law. Namely, activities in Norway are taxable in Norway. To ensure correct taxations of individuals and domestic companies, that has its challenges. I'm the first to say that. For example, the black economy in certain industries. But I must also say the taxation of multinationals with complex company structures is much, much harder. It's my view that we would not do our job if we did not pursue the multinational corporation segment, even though it's challenging, resource intensive, filled with obstacles, secrecy from nation states, companies and their advisors. Because when the tax burden is unfairly distributed, we risk loss of trust and legitimacy for a tax system. It's negative for the tax morale that large companies can plan how little they shall pay in tax, while smaller companies and ordinary wage earners contribute their fair share. It erodes the tax base and contributes to the distortion of competition. What has seemed reasonable for each country to give a tax exemption to companies or industries has been negative for the jurisdiction where the profit is earned and consequently for the international community as a whole. That's why it is a priority for us to examine whether multinational companies pay the correct tax to Norway. As a result of our efforts, we uncover large amounts every year that should have been taxed. So what's the main elements included in tax planning? What are the legal matters? What are we addressing nationally? And to look into some of the tax and legal issues. Tax planning consists of several elements, including organizing the business activities in different countries, taking advantage of conceptual differences between tax treaties and national taxation rules in individual countries. There are various legal regulations in different countries, creating the basis for companies shopping around for the lowest tax. Some tax structures have become publicly known, such as a double Irish with a Dutch sandwich. That's a nice phrase. This technique involves sending profits first through the one Irish company, then to a Dutch company, and finally to a second Irish company headquartered in a tax haven. Such techniques are most prominently used by tech companies because these firms can easily shift large portions of profits to other countries by assigning intellectual property rights to subsidiaries abroad. Ireland and the Netherlands have recently indicated that they will abolish this possibility, and I'm of course very positive to that. Many companies are in the grey area of what's legal. These companies are fully aware of this, and the planning often takes place based on risk assessment and with in-depth assistance of advisors. They plan how they can utilize different rule systems within countries and tax treaties between countries. The companies will undertake a risk assessment, including assessing the risk of disputes with tax administrations. It is therefore quite rare to see activities which are clearly illegal. Nevertheless, it is important and necessary to get legal clarifications on what's legitimate tax planning and what is illegal. This is why both companies and the tax administrations take cases to court in order to get various clarifications. The tax administration has but one goal, and I will emphasize this, and that is the right tax at the right time. We have no interest in higher taxes than necessary or correct. We have no personal interest in the outcome of cases. While I've been talking, I'm sure that you have understood the structure of this company. So I'll move to the next slide. What we are addressing nationally, yeah, that was the double Irish within a Dutch sandwich. What we are addressing nationally, today I'll give a few comments on that. The multinational companies' subsidiaries in Norway are usually operational companies within the global structures and contribute profits to the group. For example, it's not uncommon that the Norwegian companies are heavily leveraged and pay high interest rates to companies further up the system. This is because Norway, firstly, has a relatively high company tax rate, good opportunities for multinationals to get tax deduction for interest rates, though reduced from 2014 with new regulations. And thirdly, many tax treaties with other countries. This makes the complicated tax structures predictable and prevents double taxation. Another example is that the multinationals charge royalty on Norwegian subsidiaries. Royalties are fully tax deductible in Norway. The royalty is normally paid to a low tax country, which owns all the intellectual property of the multinational group. Norway does not have withholding tax on royalty payments. Figures from 2012 and 2013 show that about 40% of the Norwegian companies paid income tax here. Losses and losses carried forward are the cause of the majority of the company's lack of tax payments. But there is also much that can be explained by intra-group transactions. In December, in only a few days, the Shale Committee will present its recommendations on corporate taxation. We await the report and hope the debate that follows will include topics such as the unequal tax burden between national and multinational companies, as well as the need for transparency in tax planning strategies. A significant step in Norway's legislation to improve our capability in this issue comes with the restrictions on the deductions for interest payment between companies in the same group. It's not uncommon for Norwegian subsidiaries to have large loans from other companies in the same group and pay high interest rates. The rate can be deducted against the tax in Norway, though the money remains in the same group. This rule will reduce the incentive to have high leverage and high interest rates on Norwegian companies. The tax administration will maintain the attention on the intercompany financing, as there are still issues related to intercompany financing also after the new rule has taken effect. One topic we will be looking at is acquisitions and how the debt structure is constructed in the group. Many OECD countries have significant experience with interest limitation rules, and we will learn from these or from their experiences, such as from Germany. And now to transfer pricing, which Grace also touched upon this issue, which involves looking at intercompany transactions across borders. The multinational enterprises have incentives to shift profits from Norway to countries with lower or no corporate taxation, and this is done by increasing expenses or by artificially reducing the income base in Norway. Companies will intentionally misprice the transaction, for example on goods and services, which leads to a price that would not have been agreed upon by independent parties. There is a considerable element of discretion in transfer pricing. The general rule is that transfer prices should reflect the price and the conditions that would have been agreed if the transaction had occurred between two independent parties. The tax administration considers whether that has happened. Since 2009, our strategic focus on transfer pricing has increased the taxable profits by 47.9 billion Norwegian kroner. In 2012 and 2013, our efforts with transfer pricing in multinational companies led to the disclosure of 14 billion Norwegian kroner in a total of 249 cases that we believe should have been taxed. And we believe that this is not the whole picture. From January 2014, we strengthened this commitment further by creating a national project which exclusively focuses on transfer pricing. We now have a centralized team of over 100 people who work with precisely this issue. Here's a picture from Finansavisen, our employees in the transfer pricing team. We also start our audits after a risk assessment. We always start our audits after a risk assessment. As an aid to risk assessment, we use, among other things, the form controlled transactions, and accounts outstanding, as well as information in databases. The controls are implemented as a top tax audit. The Central Office for Foreign Tax Affairs can also conduct inspections abroad. The starting point for the audit is the submitted documentation. The audit aimed to confirm or deny the company's explanation of the conducted activities in Norway and whether this should have been conducted between independent parties. The basis for taxation in Norway is what functions, assets and risks the company has in Norway. We also look at what the multinational company has of activity and income abroad. In transfer pricing, the controls can often take several years, so the process from start to finish is hard to predict. We believe that there should be greater transparency in how the corporations act, and we work towards achieving this. We would, for example, welcome a more specific documentation obligation of pricing. The quality of the documentation of how the price is determined is not good enough in Norway. The documentation is often made abroad and not adapted to Norwegian conditions. In addition to the specific priority we have placed on transfer pricing, the main part of our efforts with multinationals takes place at the Tax Administration's Central Office for Large Enterprises, the SFS. We are in the middle of a reorganization of how we handle the large enterprises. From 2015, we are strengthening our efforts by directing all tax issues of group companies with a turnover of more than 3 billion Norwegian kroner to the Central Office for Large Enterprises. We also increased the number of employees at SFS substantially. The methodology used on these large taxpayers gives us continuity in working with individual companies. And we are able to utilize our expertise through working in teams throughout the whole taxation process. This provides a high level of competence in relation to the risk of certain groups, but also improves our knowledge of certain business sectors. We also participate in OECD's work on country-by-country reporting. If such reporting becomes mandatory more widely, it can be a useful tool in order to get a broader overview of the company's structures and activities. It will be one of several sources we use when we decide which companies we should audit. However, it's not a silver bullet to combat the problems of BEPS. Transparency is related to two factors. Firstly, the exchange of information between states. Here we are making tremendous progress, I would say. Secondly, the need for transparency in tax planning strategies. This is also relevant with lawyers' professional secrecy related to access to structures they have designed. Luxembourg leaks can be a sign that this is changing as it has exposed how they operate and might lead to further material becoming publicly available. The disclosures in the Luxembourg leaks highlights the necessity of international solutions to international tax problems. It's up to countries to change laws so that the tax is paid according to the intention. Here I'm optimistic. The international pressure in the OECD and the G20 countries, combined with the reactions worldwide created by the Luxembourg leaks, suggests that the fight against aggressive tax planning and the lack of transparency in the tax treaties is succeeding. It's just recently that this has happened. Journalists from all over the world joined forces and investigated money transfers to Luxembourg, revealing complex company structures created to avoid taxes. More commonly known as the Luxembourg leaks, as I call it. Now, are we surprised by what we see in this new base of information? I would say that we're not extremely surprised. We are well aware that some countries offer special deals with companies that provide significant tax reductions. Similarly, we are also well aware that there is an entire consulting industry in the tax world that assists companies in setting up business structures with a specific purpose to minimize their tax. The main problem is that this type of tax treaties gives a business tax exemption on profits that should have been taxed in the country the money was actually earned. The main challenge is that it's very difficult to get insight into these agreements. Now, are the documents that we find in the Lux leaks, are those useful? It's a bit early to tell, actually, but we have already started to examine the databases to see if there is information that we can use. This work is far from finished, and we do not know yet if we're going to get any major effects out of this. So what are the challenges? The challenge is that we have to look at the transactions carried out in Norway. We will search for information in the material that can provide insight into transactions that goes out of Norway. Then we might have the opportunity to challenge the validity of the structures or the transfer price of the transaction to and from Norway. The recent issues exposed in Luxembourg can also give us an indication of the risk profile of taxpayers whose financial transactions are structured in this way. So it is not only the companies mentioned in the leak that may be of relevance to us, but all companies with such structures. When we consider a taxpayer to have such a risk profile, we will consider a more thorough audit of other transactions conducted as well. This is because our international experience suggests that companies with aggressive tax planning in one area are likely to have the same strategies in several areas, and that the boundary between such tax planning and tax evasion is moving. So, the leaks from Luxembourg are important for us and other tax administrations because they will affect our efforts to get access to such agreements and related information. So finally, to wrap up, we experience firstly consensus among tax administrations to change the harmful practices of aggressive tax planning. Secondly, the issue has solid momentum at the moment and backing from politicians and the public. Thirdly, we are addressing this issue in several ways nationally through pooling and strengthening our resources to address transfer pricing in large companies. And finally, I must say that I'm hopeful and somewhat confident as well that we will see changes over the next couple of years in this area with regards to tax planning and exchange of information between tax authorities. Thank you for your attention.